Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today's episode 145, Market Season with Brandon Reed. Brandon, welcome back to the show.
Good to be back. Thanks for having me.
Yeah, absolutely. It's so what are we looking at? Month 2 here at Falcon Wealth Advisors?
Yeah. It's been a pretty exciting month, getting my feet wet and, working with everybody on the team and having my second appearance on Upticks.
Right. So things are rolling right along here. And just so all of the listeners and the viewers know, Brandon is serving a hybrid role on our team. So he's definitely all in now in our research and trading team. And that's what we're going to be talking about today. But that's only half of his role. The other half, he is a fully licensed financial advisor. So he is working with new clients. So if you or someone you know is interested in working with Brandon, he definitely takes a little bit more of a market approach. But of course, he's got all the financial planning of Falcon Wealth Advisors available to him on his background. So we're excited about that. Starting to work with some new clients and things are rolling here. So really good.
Yeah, they are. Yeah.
All right. So as of the recording of this show, it's getting here towards the end of May, 90% of companies have already reported their earnings. So why don't you just kind of start here, Brandon, with a high level overview of what we've been seeing and quick time out here for our listeners. And if you're a client of Falcon Wealth Advisors, you've heard me say time and time again, earnings are the most important thing when you're looking at the stock market. So Brandon, why don't you give us a little quick recap of what's been going on here?
Yeah, sure. And we were talking about it on my first appearance on Upticks. We were, looking forward to earnings season because this is going to be that first quarter where we've now looped what happened last year during COVID, right? Companies have reported a normalized quarter, more or less, following what happened in March and April of last year. And what we're seeing is with 90+% of companies reporting over 50% earnings beats or over 50% earnings growth and over 13% sales growth. That's huge. Those numbers are absolutely phenomenal. And when you look at actually where we were in April, the market was looking at about 30% earnings growth and maybe 10% sales growth. So even just from April to May, the earnings growth from these companies, the expectations and the beats have come in even more than what we thought just a month ago. So it's phenomenal. It's honestly what we had talked about, at the end of last year, what we'd hoped to see heading into 2021, and we're seeing it across the board. Every technology is doing well, consumer discretionary in terms of the earnings beats and the sales growth, industrials, it's, up and down the spectrum, companies are doing well. And we wanted to see that, we needed to see that after the rally we had in 2020. We needed the earnings to be there and they've been there.
Is there an argument though, Brandon, that earnings are just up because everything was shut down and was so bad in 2020?
Yeah. And I think that's, that was the expectation, that the base effect from 2020, the low earnings would lead to high earnings and sales growth this year. Right. And we've seen that. We were also, though, to my previous point, we were looking at maybe 30% earnings growth just a month ago. So the actual magnitude of the growth is growing day to day, week to week as these companies report. And something that we've seen with the most recent quarter and actually the last 2 quarters of 2020, the surprises that companies are reporting, the positive earnings and sales growth surprises, are north of 20%.
Wow.
The average back to like the 1990s is about 3.5%. So the magnitude that these companies are beating, and again, it's across the board. It's technology, it's financials, materials, all these businesses, no matter what you do, you've had a lot of growth, even above what the market and analysts had priced in. So that's, I think the argument, maybe the question to ask is this as good as it gets? And it's too soon to say. Second quarter is going to be just as good. We'll probably have a tapering of growth in the second half of the year, because actually the second half of 2020 wasn't horrible for a lot of businesses. But this is what we want to see. We want to see the economy and businesses start to fire on all cylinders. So it's encouraging, and it certainly supports the rally we've seen in stocks both last year and this year to date.
Good. So I get a lot of questions asking me, that same question is, the market's up so much, Jake, when is it going to roll over and pull back? And obviously we can't time the market and we don't know that for sure. But I guess what you're saying is we should feel good about these current levels because the earnings is coming and backfilling and supporting that. And maybe before we go into the market reaction, can you maybe explain where the strength is? Like which sectors? Because you mentioned how tech is doing well, but I know that's not necessarily leading the market this year.
Right. Yeah. And actually, in the case of maybe software, specifically the industry inside of technology, software is down year to date as of yesterday. So the strength, and we'll get into, where the actual performance has been, but the beats, if we're talking about just earnings growth and sales growth, we knew technology and we knew a lot of these businesses that thrived during COVID, they did well last year. They had earnings growth and they had sales growth last year. It was the financials, the materials companies, some healthcare. There were industries that did not actually grow because they were directly impacted by what happened with COVID. And now we're seeing the growth there. So whether that's the retailers up over 100% in terms of growth, not performance, but growth, financials, materials, industrials are now looking to be flat. So they're no longer negative, but they're looking to be flat, at least from a sales perspective. So the businesses that needed to recover are recovering, and they're recovering in a magnitude much greater than obviously the ones that weren't impacted necessarily in a negative way by COVID. And that's where the leadership, and we can kind of transition into performance. Year to date, like I just mentioned, software is down, technology's hovering above the flat line. Materials are up over 35%, I believe. Financials, energy is huge. Energy has been a huge winner both year to date and recently. Consumer staples has done all right. Real estate's done really well. Industrial. So the cyclical component of the market and really the value component is probably something you've either talked about with clients or we've certainly seen with financial media. We've looked at the growth versus value dynamic for how many years now. Right. I was talking to you yesterday. So this year, if you break it down into a weekly return stream, value has actually outperformed growth 14 weeks out of the year. We've only had about 20 weeks in the year. That number hasn't happened since 2017. Value has not gone on a run like this since right after Trump was elected. And we know when Trump was elected, there was the investment in America, financials did really well, infrastructure plays did really well. It was less tech, it was more value. And we're seeing that again. And there's reasons for that. And it's too soon to say if this is going to continue into being a trend where it makes sense to have a larger investment in value. But the businesses that are growing because they were beaten down by COVID are also the businesses that are doing the best year to date. And it's not just a month now. We're 5 months in, 5.5 months into the year. So this is looking like something that investors, clients just need to be aware of. The market is changing, and who knows how long it changes for, but it's important. This is something that we need to pay attention to.
Right. And before I get into, because I'm really proud of what we did at Falcon Wealth Advisors in anticipation of this, but I'll take a quick time out here, is that we hope all of you out there are staying safe and healthy, of course. If you want to make sure that you don't miss another episode of Upticks, be sure to subscribe to this YouTube channel or on your favorite podcast player. Also, I'm out there on various social media platforms. So I'm on Facebook, Instagram, Twitter, and LinkedIn. And Falcon Wealth Advisors are on the same 4 platforms. So we're on Facebook, LinkedIn, Twitter, and Instagram. So feel free to send us a friend connection. And if you're not subscribed, or if you like our content and want to we'll do a quick plug here. There should be a subscribe button here to click on, or just give it a thumbs up. That way more people get to see our content. So quick commercial there, Brandon. So, what I'm really excited about, and this is very important, I think, for our listeners, whether you're a client or you're thinking about becoming a client of Falcon Wealth Advisors, is that our team, while we are paying very close attention to growth versus value, international, US, individual stock selection, we don't go and chase it. So like Brandon mentioned, growth had been the winner many, many years, and our portfolio still had a value allocation. In fact, it's pretty equal. And so we're getting to participate now in this value rally. And in fact, we took it a whole nother level at the beginning of the year. We shifted our portfolio from a market cap weighting to an equal cap weighting. And so we didn't think that tech was going to do poorly, but because tech had become so overweight in the sector as far as the weightings are concerned, we just took more of a neutral approach in our portfolio. Again, very proud. And again, every client's a little bit different, of course, but we're really proud of our performance year to date because of some of those well thought out shifts.
And I think it's an interesting point, and it's worth talking about, because understanding what you own is in educating clients and prospects is a huge proponent. We are a huge proponent of that. And it's one of our core tenets. And I think when you look at over the last 5-10 years, really since the global financial crisis, and how well tech is done, how well the NASDAQ is done, most portfolios, whether actively managed or passively managed, have, to your point, a large exposure to technology. And It's been the right thing to do. And to the extent that this value trade or this value trend becomes something more, it's prudent to realize that unless you are trying to rebalance and reallocate dollars because tech has done so well, you're going to be overexposed to something that might not do as well. Again, we can't predict the future, but unless you're looking at your portfolio, unless you understand what's in it, you can be on the wrong side of these trend changes. And given what, we can talk about inflation a little bit, but given what's going on in the economy with stimulus, and again, what we're seeing within just the market dynamic of growth value and whatnot, these changes are happening. And being on top of it and being able to rebalance and prepare your portfolio for what's coming or what may come is a huge piece of what we do here. And it's incredibly important. I can't understand that.
I agree. So let's talk about inflation. And so, with earnings doing well, stimulus being pumped in, I've got more and more clients asking me, Jake, is inflation going to be a huge problem here? And maybe give us your thoughts on commodities and inflation and how we play that.
Is it transitory, or is it here to stay?
Right.
I think it's we had that. So it's interesting. The last 2 weeks, 2 weeks ago, we had, or maybe just over a week ago, we had the labor print from April, where the jobs report was negative, or not negative, but it was much weaker than expected. We had the really hot inflation number. It was 0.9% increase in core CPI, which actually includes everything except food and energy. So price appreciation month over month was 0.9%, almost 1%. Wow. That was the hottest number since 1981 on core CPI. So we haven't seen a month over month increase like that since the 80s.
What do you attribute that to? Do you know what the cause of that?
So it was, we joked in the office that one of the inputs for that was used auto prices were up 10%. And I know it's not something our clients will ever see, but you could have, bought a used car and sold it for 10% more month over month. I think those are on an annualized basis. But the point is, everything is seeing an increase in price. You're paying more at the grocery store, I'm sure. We're paying more at the pump. We can talk about commodity prices, whether it's lumber, corn, the base metals, copper, gold, all these things throughout the year have seen a dramatic increase in price, either consistently or at points in time. So all of the inputs for company production, all of the things that we buy at the store, or again, pay at the gas station, everything's going up in price. And at some point, if that's sustainable, that requires a shift in how you approach your investment portfolio, whether that's from a bond perspective, lowering the maturity range that you're investing in. So instead of investing in 10, 20-year bonds, you're trying to reduce that maturity range, something in the 5-year potentially, and not to get to, in the weeds, but there's things you can do on the bond side. There's places you can allocate to on the equity side, whether that is the commodity complex, because as inflation goes up, it's the lumber prices, it's gold and whatnot, energy prices, all of those things are inflationary by nature or benefit from inflation. So having allocations for those sectors and those industries makes a lot of sense. And again, we don't know yet. So it was one number, and I'm not one to say, one number is not a trend yet. We can wait for more to come in. But if this is the case, if we see higher inflation because of stimulus, because of the economic growth that we're hopefully going to continue seeing, and Fed policy notwithstanding, the prospects of what that does to a portfolio that had been predominantly growth in technology is important. And I think preparing for that is something that's we're doing certainly internally, and we're watching very closely.
Right. Excellent. Yeah. And that's exactly right. And so that's what our clients are paying us for, is that, again, we're not trying to time the market at all, but we're aware of these macro events happening around us. And if we need to shift the portfolio to help our clients take advantage of the current economic environment, we're not going to hesitate, and we're going to do that. Again, as fiduciaries, we're legally bound to only act in our clients' best interest. So we're not selling widgets or charging commissions. When we do these things, we're doing it to protect their portfolio, their retirement nest egg, and make sure that they're participating in the appropriate sectors that are benefiting from, again, inflation or whatever may be happening. So good, very good. So what are some of our key takeaways then, maybe as we wrap up the show here?
I think the biggest thing for me, and this is something I believe wholeheartedly, is that investors and clients, prospects, anybody listening to this, anybody in general, needs to know what you own, know what's in your portfolio. Right now, there's nothing to indicate that this market is unhealthy or weak. Again, earnings have been there. Performance is diversified. Tech isn't leading the market anymore. These value companies or these commodity companies or energy, whoever X tech is leading. So we had a rotation. That's healthy. Credit spreads are tight, which means there's not a risk right now where the market doesn't perceive a risk of mass defaults and issues within company balance sheets. So that's good. Real rates are negative, which means that there's an opportunity. Again, equities are the place to be. So all of those things right now lead to the market being healthy, but within the market, provided you're not over allocated to one thing or the other, you can do well and you can benefit from what comes next. Nobody knows what's coming next. We can all have we all have our stances. Inflation may stay here for a while. Value may stay in favor. Commodities can continue to run. We don't know, but as long as you understand what's in your portfolio, you understand that what comes next, you'll be able to participate in. And I think that was your point. That is your point with the rotation from equal weight or from market cap weighting to equal weighting. We wanted to participate because we'd already had the benefit of the tech run up. We wanted to participate in the things that had underperformed. And I think that's, far and away the biggest takeaway. Understand what's in your portfolio. Make sure that you're having conversations with your advisor, whoever you talk to about this stuff, so that you can stay on top of what's going on. And I'm not advocating for day trading or market timing. I'm just saying, know where your portfolio is allocated. And when things happen in the market, you can be prepared to either adapt and change, or you're already there, you're already participating.
Perfect. Yeah, thank you. So if you're a client and you're watching or listening to this and you want to be more informed on your portfolio, anytime, like Brandon said, reach out to your advisor. Certainly we can bring Brandon in or someone from the research team to go a little bit deeper. But that's what our clients are paying us for, right? So we want to keep you educated out there in what you own. We know what you own and why you own it, and we can certainly articulate that to our clients. And if you're not a client of Falcon Wealth Advisors and you want a second opinion, we're certainly happy to offer that as well. So thank you so much for joining me on the show today, Brandon. I know you're married and 3 kids, so you've got a busy life outside of Falcon Wealth Advisors. We're recording this show on a Friday. Do you got any plans for the weekend?
Yeah, I think I'm going to try to get around to golfing, provided we've had a wet week. I don't know. I might have to mow the lawn too, but between those two things, we'll see.
Good. Well, thank you. And thank all of you for tuning in. Like I said, we hope you're out there staying safe and healthy. And we look forward to kicking out more shows of Upticks. Brandon, why don't you share your email address? That way, if anybody has any market questions specific, they can just ping you directly.
Perfect. It's Brandon. My name, Brandon, BRANDON @FalconWealthAdvisors.com.
Perfect. Thank you again for tuning in, and we hope you all have a great week.